8. Business ownership and legacy. In character, in manner, in style, in all things, the supreme excellence is simplicity. Henry Wadsworth Longfellow. In this chapter, we will think through and consult with trusted advisors about the best way to structure business ownership and create a business legacy. The most common forms of business ownership are sole proprietorship, partnership, limited liability partnership, limited liability company, LLC, series LLC, and corporations, which can be taxed as C corporations or S corporations. These are all different forms of ownership, and selecting the right type of business ownership varies depending on the mission and vision of the business. Among the different business structures, a sole proprietorship is the simplest form of business ownership. Apart from being a common preference by business owners, it is also owned solely by an individual. It is an unincorporated business owned and run by one individual with no distinction between the business and the owner. The business owner is entitled to all profits and is responsible for all the business's debts, losses, and liabilities. Some of the main advantages of a sole proprietorship are having no boss, easy and inexpensive to form, complete control, and easy tax preparation. Some of the disadvantages include unlimited personal liability because there is no legal separation between the sole proprietor and the business. The proprietor can be held personally liable for the debts and obligations of the business, including any liabilities incurred as a result of employee actions. It is hard to raise money because of the perceived additional risk when it comes to repayment if the business fails. And the proprietor is responsible for the failure of the business. When it comes to taxes, because the proprietor and the business are one and the same, the business itself is not taxed separately. The sole proprietorship income is the taxable income. The income and/or losses and expenses are reported with a Schedule C and the standard Form 1040. You can find more information about sole proprietorship, taxes, and forms at irs.gov. The main reason for forming a limited liability company or corporation is to limit the liability of the owners. In a sole proprietorship or partnership, the owners are personally liable for the debts and liabilities of the business. Also, creditors can go after all of their assets, business and personal, to collect. If an LLC is formed and operated properly, the owners can be protected from such liability. The creditors can take the bank accounts, cars, real estate, and other property of any partner to pay the debts of the partnership. If only one partner has money, he or she may have to pay all of the debts accumulated by all the other partners. When doing business as an LLC, the company may go bankrupt, and the members may lose their initial investment, but the creditors cannot touch the assets of the owners. The limited liability company offers the greatest benefits when compared to partnerships and sole proprietorships. Most partnerships and sole proprietorships often switch to an LLC. Some of the advantages of the LLC include continuous existence, limited liability, ease of transferability, sharing ownership, ease of raising capital, and ease estate planning. A limited liability company may have a perpetual existence. When a sole proprietor or partner dies, the assets of his or her business may go to his or her heirs, but the business may no longer exist. If the surviving spouse or other heirs of a business owner want to continue the business in their names, it will be considered a new business, even if they are using the assets of the old business. With a partnership, the death of one partner may cause a dissolution of the business. If a member of a limited liability company does something negligent, signs a debt personally, or guarantees a company debt, the limited liability company will not protect him or her from the consequences of his or her own act or from the debt. Also, if a limited liability company does not follow the proper formalities, it may be ignored by a court, and the owners or officers may be held personally liable. The formalities include having separate bank accounts, filing annual reports, and following other requirements of state law. A limited liability company and all its assets and accounts may be transferred by the simple assignment of an interest in the company. With a sole proprietorship, each of the individual assets must be transferred, and the accounts, licenses, and permits must be individually transferred. With a limited liability company, the owner of a business can share the profits of a business without giving up control. This is done by setting up the share of profits separate from the share of ownership. A limited liability company may raise capital by admitting new members or borrowing money. In most cases, a business does not pay taxes on money it raises by the scale of its shares. An LLC has all its own bank accounts and records. A partnership or sole proprietorship may have trouble differentiating which of his or her expenses were from business and which were from personal items. With an LLC or corporation, ownership of the company can be distributed more easily than with a partnership or sole proprietorship. Different beneficiaries can be given different percentages, and control can be limited to those who are most capable. This is done by having different classes of ownership, different distribution of profits, and different levels of control. Death taxes can be minimized or avoided if small amounts of ownership are transferred tax-free each year before death. As always, consult with your tax expert because the IRS rules must be followed carefully. Some of the disadvantages are the cost of creating a limited liability company, LLC, in comparison with creating a sole proprietor or partnership. A limited liability company owner may have to pay unemployment compensation for herself, which she would not have to pay as a sole proprietor. Also, a business owner must keep her personal business separate from the business of the limited liability company. The limited liability company must have its own records and money must be kept separate. Ray, a Harvard Business School OPM 32 business owner in Boston, who I interviewed for this book, created various companies with different types of business ownership to take advantage of the tax laws and to accommodate his family business legacy. This entrepreneur has 3 daughters and wanted to make sure that they all had an opportunity to run and own businesses, which included real estate. I was impressed when I interviewed Ray because he had created a family charter or protocol to enable the family to be united in their decision-making and to promote both short and long-term family business goals. The family charter specifies rules, responsibilities, and obligations relating to the ownership and management of the companies, as well as the values that will guide family members' conduct in the community. This savvy business owner created an effective family charter that captured important benefits, both tangible and intangible, to facilitate a smooth process for leadership succession, a tangible benefit. Ray knows that not creating a well-established and codified formal plan for succession may produce disastrous consequences for a family business. Therefore, he created and maintains a family business legacy through family charter provisions that promote family unity and affiliation. Philanthropy and other joint activities have, over the last 30 years, promoted family cohesion and bonding. According to the Boston Consulting Group, a comprehensive family charter covers the following 7 topics. A family charter provides clear guidance and can relieve the stress of the new generation. It should specify the term of the charter and a process for revisions, including how long the charter will remain in effect and how the term can be extended or renewed, as well as the process for amending or adding provisions to the charter. It also specifies the philanthropic or other local, regional, and global joint activities that the business should promote, and thus creates family cohesion and bonding. A family charter also stipulates the family member's succession and involvement in the business, and the principles that will guide the leadership succession process, and how family members' performance will be evaluated and compensated. It will also establish guidelines for management of business ownership and what restrictions and incentives should be in place to keep ownership of the business within the family. A family charter addresses governance and how the family should be organized and governed to achieve its vision and promote its values. As businesses and their families evolve over time, the governance structure must also be re-examined and renewed based on family values and market environment. It will also identify the family core values and vision for its role in the broader community. Philanthropy helps build relationships with clients and potential clients. It helps build and support the business brand. It promotes employee engagement, and good corporate citizens want to do business with others who share their values. A family charter should specify who is considered a family member. Traditionally, family is a group of persons related to one another by blood or marriage, or a group of parents and children living together in a household. There is no one right way to define family. Family could be a group of people affiliated through bonds of shared history and commitment to share a future together, while supporting the development and well-being of individual members. In some instances, the leadership role is passed on to the daughter or son-in-law. For instance, at Walmart, a large family-controlled company, Greg Penner, the grandson-in-law of Walmart founder Sam Walton, took over as the chairman of the board from his father-in-law, Rob Walton, in 2015. According to my Harvard Business School professor, John Davis, a family or a non-family member, whether within a family enterprise or outside it, can be an effective CEO. Also, with more women in business, we are seeing more women involved in their family businesses' day-to-day management, such as Abigail Johnson at Fidelity Investments in Boston and Delphine Arnault at Louis Vuitton in France. A family charter will also address governance and how the family should be organized and governed to achieve its vision and promote its values. In their book, Entrepreneurs in Every Generation, Alan Cohen and Parmadita Sharma provided us with a set of propositions that will help the family members with governance, including but not limited to the following: building influence upon reciprocity and exchange and respect for the stakeholders, even when you disagree with them. It is important to understand the why behind the disagreement to explore new and more creative ideas. Start with what is in it for those you wish to influence. For example, preserving the future of the company. Try every new goal as a pilot project. Create data, learn from it, and adjust as you go, and involve others to help with the project. Emphasize the opportunity to learn, rather than how this will prove others should have learned. Learn from differences of opinions. Provide service to the business of family that no one else wants to do to build credibility. Outwork everyone. It will be noticed. Participate in interesting family business conferences that you can jointly attend. Look for influential allies. Get to know them. Find common ground. Always be looking to what you can do for them. Be thoughtful, kind, and generous to everyone in the company. Enterprising families value the we over the I. I know that the most important part of transitioning a family business is to have a well thought out, defined, and clearly communicated plan for both family and non-family members. The plan may change over time, and as the business evolves, But in the meantime, everyone will be able to know the business goals and objectives. In my experience, it is important to separate business life from family life. Discuss business decisions at the office and enjoy family discussions around the dinner table. I have seen mistakes families make that lead to broken businesses. However, it is often preventable if the owner runs the business as business first and family second. This is not to say that the business is more important than the family. Instead, it means that the business owner loves and honors the family, and she is going to properly manage the business to ensure financial security and well-being for the family. Of course, communication is key, and although some family members may not like some policies and procedures, they deserve to know the rules of engagement in the family business, and then they can decide whether they want to be part of the family business or not. Keep in mind that there are advisors that can help the family business owner to work things out with family members and stakeholders, as well as to properly structure the business and establish policies and procedures to create a family business legacy. I shared with you various ways to structure business ownership and create a business legacy, and you must now select and decide along with your trusted advisors which of these business ownerships will enable you to accomplish your unique family business legacy.